Hello class, welcome to this particular video. I'm going to take you through the content of week 4, which is on how do we post transactions in the ledger accounts. In the notes that you have, I've tried to explain how we go about it, but on the same, there is a question and answers that I've just posted, which I hope you have gone through it. But for that case, I want to go and do an illustration and actually demonstrate and highlight and emphasize on some key areas that you need to understand. You will realize that whenever you open ledger accounts or whenever you record transactions in the ledger accounts, at all time, you must make sure that you observe the dual concept or the double entry concept. That is, you must have two accounts that are affected by each and every transaction, and one of those accounts must be debited and the other one must be credited, and then you will be now able to have observed that particular criteria of the double entry concept, which is actually the main accounting concept that we apply in accounting. If you can go through the illustration that I've given, illustration 3.4, there is a question that has been solved, but I want maybe to give you some clear information on how it was done. It is a business of Kencom Enterprises, where by now the accounts were supposed to be prepared. I want to go direct to the transaction that occurred on 1st of May 2023, where business was started using 200,000 shillings in the bank. Note this, anytime business is starting, capital is normally involved. And this capital is in form of cash that is deposited in the bank. That's why if you come here, you realize that the transaction for 010520x3, it was recorded in bank and capital. That, remember, you can be able to note here capital 0105, and then bank we have here 105. Note here, bank is an asset, and whenever the owner pumped money into that particular business, bank increased. That's why it is debited. So we debit this one by capital. Remember, if it is capital and bank that are affected, in the bank account, we normally use the word capital because that is the other account that is affected. And when we go to the capital, we use the word bank because it is bank that is also affected by that particular transaction. Remember here, they normally interchange. The names, they normally interchange. In the bank, we normally use capital, and in capital, we use the word bank. But remember, those dates must be similar, 01, 05, 01, 05. Bank is debited because it is increasing, and increase in an asset is normally debited. Anytime we increase capital, it is normally credited, and that's why in the capital account, it was recorded on the credit side, that amount 200,000. We go to the transaction that took place on 0205, purchased goods worth 17,500 on credit from wholesalers. Note I've just said in the previous audios that anytime goods are bought, we normally open the purchases account. We normally open purchases account. That's actually why we have the purchases account here. And the purchases account is normally debited. And these goods were bought on credit from wholesalers. Remember, anytime we buy goods from a supplier on credit, that supplier is normally a creditor. So wholesalers, in this case, it's a creditor or a liability. And anytime liabilities are increasing, they are normally credited. So if you confirm here, you will find that purchases is debited by wholesalers 17,500, that is 205. When we go to wholesalers, remember they are our creditors, you will find that it is recorded on the credit side. It is recorded on the credit side 0205, like that. Note there, we have credited this account for the wholesalers, and we have debited the purchases account. So we have got now the observance of the double entry concept. There's a debit entry, and in wholesalers, there's a credit entry. The next transaction here took place in 0305, whereby equipment of 15,000 was bought, paying by check. Remember, equipment, it is not goods, so it cannot be recorded in purchases, and therefore it needs to be recorded in equipment account. So that's why if you come here to these ledger accounts that were prepared, you will find that there is an account for equipment. It cannot be recorded in purchases because these are not goods. Remember, goods are those items that are meant for sale. Equipment is not meant for sale, but to assist in the running of the business. So you'll find that because equipments are assets and they are increasing, they are debited. And then if you go now to the bank account, because they were bought by check, it is affecting the money in the bank, you will find that now bank is going to be credited. Why is the bank credited? Because money in that account is reducing. Because money in that account, it is reducing. That's why it is credited here by 15,000, but debited in the equipment because the equipment are increasing. We go to the next transaction, and this transaction took place on 0505. You will find that sold goods for cash. Note here, sold goods. Anytime goods are sold, they are normally credited in the sales account. And then these goods, they were sold in cash terms, therefore meaning that cash was received. So you will find that because cash was received, it is increasing. Cash was received, it is increasing. You will find that now in the cash, it is going to be debited because it is increasing and it is an asset. Whereas sales, anytime sales is made, it is normally credited. That's why it is credited here. So that we have this credit entry, we have got this debit entry of the same transaction, and for sure we have observed the double entry concept. We go to the next transaction. The next transaction actually took place on 0605, and it is bought goods on credit. Remember, bought goods on credit, it is the same as purchased goods on credit. If they were bought on credit, they must be recorded in the purchases account and the name of the creditor, who in this case is now PP Shah. So in the purchases, which is always debited, we debit by the name of the creditor, PP Shah, 11,500, 400, sorry. And then we need to open an account for PP Shah, an account for PP Shah, which is actually here. PP Shah is a creditor, and creditors will always be credited anytime we get goods from them on credit terms. Then the next transactions that actually happened was on 10th, whereby rent was paid by cash 1,500. Rent was paid. Anytime we pay expenses, we normally debit that expense and then we credit either cash or bank. We are crediting cash here because it is being spent, it is reducing. So you will find that on the cash account, we are going to have that entry being recorded on the credit side. So you'll find here on the credit side of the cash, we have got the rent of 1,500. And then if you go to the rent account, because it is being paid, you will find that it is on the debit side, 1,500. The next transaction that took place was on 12th, whereby stationery worth 2,700 was paid by cash. Stationery is an expense. Anytime we pay expense, it is debited, and because it is paid by cash, cash is reducing. Anytime cash is reducing, it is normally credited. Cash account is normally credited for that matter. So you will find that the two accounts that are going to be affected here, we are going to have the stationery, which is actually an expense. Anytime an expense is paid, that's why you have here on the debit side, it was paid by cash 2,700. And then when you go to the cash, it is going to be on the credit side because cash is reducing, which is actually amounting to 2,700. Then the next transaction that took place was on 18th. And what happened on 18th is that goods returned to MM wholesalers amounting to 2,300. Remember, MM wholesalers, we had bought goods from them. MM wholesalers, we had bought goods from them. So we credited MM traders at that particular date. When we are returning these goods back to MM, then it simply means that those goods or the amount that we are supposed to pay him is reducing. So we are going to debit MM wholesalers by 2,300, and then we credit purchases returns or return outwards. So you'll find this case being illustrated here. Goods returned back to the supplier is known as purchases returns. So you would come here and you notice that we have return outwards, also known as purchases returns. Once we purchase goods, we debit, but once we return them, we credit purchases return or return outwards. That's why they were credited here. And then you go to MM Shah because it is reducing the amount of money that we were supposed to pay him. MM Shah, we were supposed to pay him 17,500 because we have returned these goods. It is now recorded on the debit side. In accounting, if there is an amount that is on the credit side and there is another amount on the debit side, it simply means we are subtracting. It simply means we are subtracting. So we were supposed to pay 17,500, but because we returned goods worth 2,300, then we record here so that we can minus them. Like that. The next transactions that happened, was on date 21st, whereby received rent by check. Remember, this is money coming in form of check, meaning that it is increasing the bank. It is increasing money in the bank. So it's supposed to be recorded here. Here it was supposed to be 500 shillings, not 500. So it's supposed to be debit. The reason why we are debiting bank because bank is increasing because of the rent that we are receiving. And then remember this, there's a difference between rent paid and rent received. Rent paid is an expense, rent received is a revenue. Revenues are normally credited. So we are supposed to open an account for the rent received account or rent income account, and we credit it by 500. Shillings. The next transactions that took place was on, let me check. The next transactions that took place was on 23rd, where sold goods worth 7,700 on credit to Unity. Goods are sold. Anytime goods are sold, credit sales, and then this person who is buying from us or who bought them is known as a debtor. Get the difference from the onset. Goods sold to on credit, we create debtors. Goods purchased on credit, we create creditors. So this person who bought goods from us or from the business on credit is known as a debtor and is going to be debited by this amount, and the sales is always credited. You will find it being illustrated here. In the sales account, we credit using the name of the person who is a debtor, Unity. And then we need to open an account for Unity, who is a debtor. You will find that now we debit by that amount so that we can complete the double entry concept. Let's look at the next transaction that happened. Which actually took place on 24th. Bought a motor vehicle. Remember, motor vehicle is not goods. Then it means that we need to open a motor vehicle account, and it was bought using a check, meaning that it's affecting bank. So you'll find that bank, because it is reducing, we credit by 30,000. we credit by 30,000. Because now motor vehicles are increasing because they are being bought, you will find that you open a motor vehicle account and you debit. Open a motor vehicle account and you debit, as illustrated here. As illustrated here, motor vehicle account, then we debit by bank of 30,000. Let's see the next transaction. Let's see the next transaction, how it happened. This is the case. Paid wages by cash, 11,700. Class, you can be able to note this. We paid wages. Wages falls in the class of expenses. And we said anytime we are paying expenses, we debit that expense. So we need to open wages account and we debit. And then because it was paid by cash, cash is reducing by 11,700. So it is going to be presented like this. Cash account, which is actually here, because it is reducing, it is credited by 11,700. Then we need to proceed. It is reducing as a result of wages. Then we need to proceed and open the wages account because we have not had any wages being paid. You find it is here. It is debited. Anytime an expense is paid, you debit or you open that expense account and you debit like that. Then the last transaction, which took place on 31st, it was a case of drawings. The owner made cash drawings. Drawings, it is money or items taken from the business for personal use. Items that are taken from the business for personal use, either cash or goods, they are referred as drawings. So sometimes you might find this term missing. You can be told the owner took 4,400 from the business for personal use. So long as it is for personal use, then you need to open an account for drawings, which is actually debited, and then we credit 4,400 because it is reducing. All the cash that was in the business is reducing. So you will find that particular transaction being represented as follows. That particular transaction will be presented like this. You will find drawings because it is reducing cash. Note, anytime cash is reducing, we credit. So cash is reducing, or the cash for the business is reducing because the owner has taken that money away from the business. And then you go and prepare or open an account for drawings. Open an account for drawings, which is actually here. And the drawings is normally debited like that. After doing that, you are through with posting the transaction. It is as easy like that. You identify the two accounts that are being affected by that particular transaction, and then you note or you now consider which one of the two is going to be debited and which one is going to be credited. Upon doing that, then you just open those accounts and you record them appropriately. Note, if I have opened an account once and then I go ahead and I meet a transaction where that account is still affected again, I don't open another one. The moment I've opened, like for example, cash account, that cash account is normally going to be used to record all the cash transactions or the cash events that are affecting cash throughout that question. So I will not have so many cash accounts in one question. Any account should appear only once. If it is repeating itself, just record it appropriately. Thank you.